Do you know how your credit score affects your financial life? It's more than just a number. It's the key to unlocking doors to loans, credit cards, and various financial services. A good credit score can be your best friend, opening opportunities, while a bad one can limit your options. It's not just about knowing your score, but understanding your credit report too. These are crucial elements to grasp within your financial journey. Knowing your credit score and understanding your credit report are key steps in building a solid financial foundation. A credit score is a 3-digit number that lenders use to assess your creditworthiness. That's right. Just a few digits can determine whether you get that dream house, that shiny new car, or even that job you've been eyeing. So, let's delve deeper into this crucial financial tool. Imagine your credit score as a financial report card. It's a reflection of how well you've managed your credit to date. Just as your grades are based on your performance, your credit score is calculated based on your credit behavior. So, how exactly is it calculated? Well, there are 5 main factors. These are your payment history, the amount of debt you have, the length of your credit history, the types of credit you have, and your recent credit activity. The weight of each factor can vary, but in general, your payment history and your debt levels are the most heavily weighted. Now, credit scores can range from 300 to 850. The higher the score, the better. A score of 700 or above is generally considered good, while anything above 800 is classified as excellent. Conversely, a score below 600 is seen as poor. Why is this important? Well, your credit score determines your credit risk. In other words, it's a measure of how likely you are to repay your debts. The lower your score, the higher the risk you pose to lenders. This could result in higher interest rates or even loan rejection. On the flip side, a high score opens up a world of financial opportunities, from lower interest rates to better loan terms. But remember, your credit score isn't set in stone. It's a living, breathing entity that changes as your financial behavior changes. So, even if you're not thrilled with your score today, there's always room for improvement. Understanding what makes up your credit score helps you know where to focus your efforts to improve it. Because in the end, a good credit score is your ticket to financial freedom. And who doesn't want that? Your credit report is a detailed record of your credit history. It's a bit like a report card for your finances, cataloging your financial behavior over time. But what exactly does it entail? Let's delve deeper. A credit report contains a wealth of information, including your personal details, such as your name and address. It also lists your credit accounts, including credit cards, mortgages, and auto loans. Each account has its own section detailing when it was opened, the credit limit or loan amount, and your payment history. Think of your credit report as a biography, while your credit score is more of a snapshot. Your credit score is a 3-digit number derived from the information in your credit report. It provides a quick numerical assessment of your credit risk at a particular point in time. Moreover, your credit report also includes information about any bankruptcies or tax liens, and if you've been sued or arrested. This data is collected from public records, adding another layer of detail to your financial profile. Credit reports are updated regularly, usually every month, by your lenders and creditors. This is why it's so important to make payments on time and manage your credit responsibly. Even a single late payment can negatively impact your credit report and, in turn, your credit score. Now, who can look at your credit report? A whole host of entities, actually. This includes lenders, insurance companies, landlords, and even employers. These parties can request to see your credit report when assessing your application for a loan, insurance policy, rental agreement, or job. Bear in mind, though, that these entities need your permission to access your credit report. Without your consent, your credit report remains confidential. In conclusion, your credit report is much more than just a number. It's a comprehensive record of your financial behavior, reflecting both your past and present credit activities. For this reason, keeping an eye on your credit report is crucial for managing your financial health and spotting any signs of identity theft. Improving your credit score is not an overnight process, but with consistent effort, you can see significant improvements. Now, let's dive into some of the most effective ways to boost your credit score. First and foremost, make sure you're paying your bills on time. This might seem like a no-brainer, but it bears repeating, considering that payment history is a significant factor in calculating your credit score. This doesn't just apply to credit cards, but also to other types of loans, such as mortgages or student loans. Even utility bills and phone contracts can affect your credit score if they go unpaid and are sent to a collection agency. So, setting up automatic payments or reminders can prove to be a useful tool in maintaining a positive payment history. Next, we move on to credit utilization, which is the ratio of your outstanding credit card balances to your credit card limits. In simpler terms, it's how much of your available credit you're using. The lower this percentage, the better it is for your credit score. Aim to keep your credit utilization below 30%. This means that if your credit limit is $10,000, try to keep your balance below $3,000. Another key aspect is the length of your credit history, which can also impact your credit score. The longer your accounts have been open, especially if they're in good standing, the better it is for your credit score. So if you're thinking about closing an old credit card account, you might want to reconsider, even if you don't use it often. Now let's talk about new credit. While it's not necessarily a bad thing to open new accounts, applying for several new lines of credit in a short period can signify to lenders that you're a high-risk borrower, which can negatively impact your credit score. So, it's best to apply for new credit sparingly. Lastly, maintaining a mix of credit types can also help improve your credit score. This refers to having a combination of different types of credit, such as credit cards, retail accounts, installment loans, finance company accounts, and mortgage loans. Having a diverse mix signifies that you're able to manage different types of credit responsibly. In conclusion, improving your credit score involves a combination of maintaining a positive payment history, keeping your credit utilization low, preserving the length of your credit history, applying for new credit sparingly, and maintaining a diverse mix of credit types. But it's essential to remember that these strategies require consistent effort over time. It's not about quick fixes, but rather about establishing and maintaining responsible financial habits. The benefits of a good credit score are long-term and far-reaching, from lower interest rates on loans to better chances of getting approved for credit. Remember, improving your credit score is a marathon, not a sprint. Stay patient and persistent. Your credit score and credit report play a significant role in your financial life. They can mean the difference between securing that dream home or missing out. They can affect the interest rates you pay on loans, your insurance premiums, and even job opportunities. It's crucial to understand these financial tools, manage them wisely, and strive for improvement. Remember, every financial action you make can impact these scores. By taking control of your credit, you're taking control of your financial future. Start today and reap the rewards tomorrow.